Saludamos ya a Henry Smith, que es Investment Strategist, Multi-Asset Solutions en Alliancebernstein. Henry, good afternoon, and thank you so much for being in Negocios Televisión.
Good afternoon, thanks for having me.
First of all, Henry, I wanted to ask you about your economic outlook. How has it evolved over the last few quarters?
Sure, it's a good question. So if we think back to the end of 2022, the economic outlook was relatively pessimistic. We had inflation at persistently high levels, and it was dominating the minds of investors. We also had central banks rapidly increasing interest rates, and we had financial markets being buffeted by volatility. So you think back to that point in time, it was very pessimistic, as I say. Since then, we have seen a return toward normal for a number of areas that have been impacted by the COVID-19 pandemic and the war in Ukraine. In particular, I'm thinking of areas like the reopening of China from its lockdowns, the easing of goods and commodity supply chain pressures, and in turn, the cooling of elevated commodity prices. We've also seen several economic indicators and data points hold up better than expected, and inflation has started to cool, which in turn has improved the outlook considerably and reduced the risk of a meaningful near-term recession. That is not to say, that we see economic growth rebounding sustainably from here. In fact, we see some of those near-term boosts for economic growth as likely to fade. And so today, our base case is for global growth that is sluggish, and by that I mean considerably lower than long-term average, but importantly, positive on an annualized basis.
See as some of the key areas for strength in the global economy.
Sure. So I guess one of the key areas of strength and one of the most talked about areas of strength is the labor market. If we look across the major economies of the world, labor markets are very tight with low levels of unemployment on the supply side. And then on the demand side, there is an elevated level of job openings and corporates seeking employment growth. That said, I think it is important to note that we have seen some cooling in the labor market as the pace of hiring has eased, and as labor participation rates and immigration have improved and stepped in to try to fill that supply gap. And so a key area, sort of knock-on effect of that labor market mismatch between supply and demand has been higher wage pressures feeding into inflation. The other area of impact of a resilient labor market, and in some ways also driven by improvements in consumer confidence, has been a significant amount of consumer demand for services. And so this sector has been an area of notable strength. And I think, it's worth also mentioning, while talking about services, to mention that manufacturing has been, by contrast, pretty weak. So within that sector, this has suffered from the need for corporates to destock their inventories following the pandemic. And we are starting to expect that manufacturing will improve going forward, as inventories have now fallen significantly lower and moved below long-term averages. The sort of final area of strength that I would mention is in business investment and capital expenditure. So despite some deterioration in business confidence measures, we have seen a continued rebound in business investment over the last 12 to 18 months. And one of the key supports there has been business investment into areas like technology, which includes things like research and development and software. And this is an area that we expect to remain pretty resilient, even if the overall levels of business investment starts to moderate from here. And that's really driven by this boom in interest for artificial intelligence and sort of related technologies that we've seen this year.
To what degree do you see this economic resilience posing a threat to inflation normalization? And how do you see inflation evolving from there?
Yes, that's an excellent question. So a strong economy is definitely a challenge for central banks as they seek to weaken the economy and bring inflation back under control. While we've talked about some areas of strength in the economy this year, this really comes from the perspective and the backdrop of a very difficult environment for the global economy. And so I should reiterate that we do see a lot of these areas of strength as providing a one-off boost, or even, the impact that they provide sort of fading as we go forward from here. And so we don't expect any sort of acceleration in growth to continue sustainably into the future. And, the strength of, certain sectors of the economy, I think, is going to be something that central banks monitor very closely. In terms of the second part of your question around inflation, where we see inflation today is, quite obviously elevated compared to long-term levels. But what we are starting to see is inflation decelerate, even if that is a pretty gradual deceleration. And when we look inside the drivers of inflation today, we can see that there has been a shift away from goods-based inflation through to services like housing, food services, accommodation, and transportation. The good news is that many of these key drivers are themselves starting to stabilize and decelerate. So when we look at leading indicators such as those in the rental market, we can see that price pressures are starting to ease within housing. When we look at things from a commodity perspective, while there has been a tick up in prices so far this year, commodities still remain a way off from their 2022 highs. And so we expect lower costs to feed into commodity sensitive areas like transportation and food services. But I think the final point to really note on inflation is that it remains a lot, there's a long way to go before it reaches central bank targets. And one thing that we're monitoring quite closely is a number of longer term pressures that we see, such as things like deglobalization, such as things like aging demographics, and such as things like the energy transition, which we expect to have the potential to keep inflation at higher equilibrium levels over the medium to long term.
Mm-hmm. Henry, all this being said, what does this mean for central bank policy?
Sure. So I guess where central banks are today, they will want to preserve as much flexibility as possible, given that the inflation outlook remains uncertain. So for now, at least, we expect continued data dependence from central banks, with central banks keeping a close eye on economic data releases, as well as an end to quite transparent and open forward guidance. But with interest rates now at generally high levels, we see most major central banks sort of at or near the end of their rate hike cycles. In the US, we believe that the Federal Reserve is likely done or effectively done in raising interest rates. In Europe and the UK, we do see some scope for further tightening from here, but it's pretty limited going forward. The final point I'd make is just around economic resilience. So with some of that economic resilience, we've talked about some of the strength of certain sectors of the global economy. There are building expectations of a soft landing in the United States. And by that, I mean inflation coming under control while being able to avoid a recession. We have seen market expectations for interest rates shift such that that interest rates are now expected to be higher for longer. And if I sort of put that another way, if the global economy doesn't weaken as much as we once feared, central banks will be much slower and less receptive to cutting rates to stimulate growth.
There are barely no more interest rate hikes in the horizon. What are the risks right now, Henry?
Sure. So I guess that the most obvious risk is inflation. There is clearly a lot of uncertainty about the path of inflation normalization from here. And a more uncertain policy path will lead to higher risk premiums being baked into a range of different asset classes, as we sort of saw in August this year. This increase in market volatility, sort of kind of ironically, will actually suit central banks because it will tighten financial conditions and so help them to combat inflation. The other major risk, or sort of one to watch, I think, is China. So the relative weakness of the Chinese economy remains a key risk for the world's global growth. Recent policy measures there, seeking to re-stimulate the economy, have done little to improve sentiment either in their real economy or in their stock and bond markets. And so I would sort of end that by noting that we do believe that fiscal stimulus can and will ultimately help mitigate China's economic slowdown, but we think that a sustained improvement from here is pretty unlikely. And of course, when it comes to China, for investors considering allocation there, geopolitics also remains a major headwind.
I wanted also to ask you about how this can translate to our portfolios. How does this outlook that you just mentioned translate into an asset class positioning within your multi-asset portfolios?
Sure. So I guess from a top level perspective, a number of our multi-asset portfolios have a small overweight to equity markets. This reflects some of that stronger economic outlook that we have, and the expectation that recession risks are reducing from here. That said, we do keep our overweight to equities quite small in reflection of some of those risks I mentioned around inflation in particular, being a bit of an unknown variable going forward. The other place I would mention is fixed income. Maybe not that exciting, but actually we're pretty neutral to fixed income. On the one hand, we've seen gradual improvements in the level of inflation, and the fact that central banks are reaching the end of their interest rate hiking cycle is pretty supportive for the asset class. We have also seen equity bond correlations, improve from, pretty positive levels. And so that's supportive. But kind of on the other hand, and leading us back to a sort of neutral position, is the recognition that inflation is still elevated, inflation is still high, and that we have a pretty unattractive inverted yield curve going forward, which poses a headwind for the asset class. The only final point I'd make on positioning is just around diversifying asset class exposures. So some of our portfolios have a small tilt towards commodities, and this position is really driven by improving fundamentals in the energy market, a potential bottom in manufacturing activity, as I sort of touched on briefly, but also upside risks from geopolitics and seasonality as we head into colder weather.
Henry Smith, investment strategist, multi-asset solutions at Alliancebernstein. It's been a pleasure to have you here in Negocios Televisión. Thank you so much, and have a good afternoon.